Welcome to Iron Financial. This is the only place to forge a stronger portfolio and cut right through the market weakness. I'm your lead analyst. Listen, today we are not just looking at another earnings report. No, we are conducting a full-blown structural inspection of a financial titan, Citigroup. They just dropped a Q1 report that, let's be honest, on the surface, it looks like a brand new skyscraper. We're talking a massive earnings beat that just blew past all the expectations. But we're here to do the heavy lifting. We're going to stress test the foundation, we're going to check the load-bearing walls, and we're going to search for any, and I mean any, hairline cracks that could compromise this entire structure. The numbers, they look strong, but at Iron Financial, we always have to ask, is this the financial fortress, or is it just a house of cards? Let's start the inspection.
So here's our inspection plan for today. First, we're going to look at the architect's blueprint, the incredible headline numbers Citi has presented to the world. Then we're going to get our hands dirty. We're going to check the foundation by digging into the quality of that revenue. After that, we'll take a look at the load-bearing walls, the core business segments, to see if they're all really pulling their weight. And this is crucial. We are then going to actively search for cracks, looking at those rising expenses and any hidden risks. And finally, we will deliver the final inspection report, our Iron Financial verdict. All right, time to grab our hard hats. Every great structure, it starts with an impressive blueprint. And Citigroup's Q1 results are exactly that. A powerful, attention-grabbing set of numbers just designed to project strength and stability to the market. So let's examine the raw specs on this build. Okay, first up, the top line. A staggering $24.6 billion in revenue for the quarter. Just let that sink in for a moment. To put that into perspective for you, that is more than the annual GDP of a lot of small countries, earned in just 3 months. This isn't just good. We're talking about a 14% jump year over year. This marks Citigroup's best quarterly revenue performance in a decade. You simply can't argue with that kind of raw power. It is a powerful statement right out of the gate, and it suggests the entire structure is bigger and more robust than it has been in years. Now, this is where the blueprint gets truly impressive. This is how that massive revenue translates into pure profit. Net income surged an incredible 42% to $5.8 billion. You see, that's not just growth, that's an explosion in profitability. When you see a 14% revenue increase fuel a 42% profit jump, it tells you the machine is running efficiently. They aren't just making more money, they're keeping more of it. And that, right there, is a sign of serious operational leverage and a core pillar of strength. So the crucial point is, what does all this mean for the owners of the company, the shareholders? Well, this is the payoff. Earnings per share hit $3.06, a 56% year-over-year increase. This shows that the strength we see on the top line and in the profit line is flowing directly down to the bottom, and it's creating substantial value. And hey, they're also returning capital, with $7.4 billion sent back to shareholders this quarter alone. By all accounts, this blueprint looks absolutely flawless. Whoa. Hold on a second. Before we sign off on this beautiful blueprint, I have to step in. Look, these numbers are big, they're shiny, and they certainly beat expectations. I get it. But a beautiful facade doesn't mean the foundation is sound. My job here is to represent every single investor watching this, asking the tough questions. Are these numbers the result of a durable, well-poured concrete foundation, or is this just some temporary scaffolding they threw up to benefit from a chaotic market? Is this real strength, or is it just market hype? Because let me tell you, hype does not hold up in an earthquake. That's a fair challenge. A structure is only as strong as its foundation, so let's do it. Let's drill down past the headlines and conduct a core sample analysis. We need to understand precisely where this record-breaking $24.6 billion in revenue is actually coming from. Let's see what this foundation is really made of. Okay, this right here gets to the heart of the foundation's integrity. It shows the 2 core revenue pillars for any bank. On one side, you've got net interest income. That's the money they make from lending, up a very solid 12%. On the other side, you've got non-interest revenue, fees from things like trading, banking, wealth management, and that's up an even stronger 17%. The key takeaway here, the thing you need to see, is the balance. This isn't a one-trick pony. The report explicitly states this growth was driven across all 5 of their core businesses. This suggests a wide, stable foundation, not a single point of failure. And look, you don't have to take my word for it. Here you have it directly from the architect-in-chief herself, CEO Jane Fraser. She frames it perfectly. The diversified business model is the engine here. She's essentially telling the market that this isn't some fluke. It's the system working as designed, providing strength during what she calls uncertain times. This is the bull case in a nutshell. A well-diversified machine built to perform in just about any environment.
I'm going to have to call that out right there. Uncertain times? Come on, that is the most polished corporate speak I've ever heard from market chaos. Let's be blunt about what was really happening in the first quarter. Geopolitical tensions were flaring up in the Middle East, threatening major shipping lanes like the Strait of Hormuz. We saw a massive sell-off in software stocks because of AI disruption fears. That isn't uncertainty, that's volatility. And for a bank with a massive trading desk, volatility isn't a headwind, it's pure rocket fuel. And this chart right here, this proves my point. Let's look at where the real outperformance came from. Fixed income trading revenue up a strong 13%. Okay, great. But look at equities trading, up a staggering 39%. A 39% jump in a single quarter isn't the result of some consistent, diversified model. It's the result of clients frantically rebalancing their portfolios and sharp price swings driving massive volume during that software sell-off. This part of the foundation isn't concrete, it's adrenaline. And adrenaline wears off. You can't build a long-term strategy on that.
You know, you raise a very valid point about the role of market volatility. A foundation has to support the walls, and those walls need to be strong enough to hold up the roof. So let's shift our inspection over to the core business segments. Think of these as the 5 load-bearing walls of the entire Citigroup structure. The company claims all 5 are contributing to the growth. We need to see if they're all carrying an equal load.
So here they are, the 5 interconnected businesses that form the core of the new, simplified Citigroup. You have services. That's basically the plumbing of the financial world, handling trade and treasury solutions. You've got markets, which we just discussed. Banking, which covers things like M&A and underwriting. Wealth management. And of course, the U.S. consumer cards business. According to CEO Jane Fraser, all of these segments saw revenue growth this quarter. It really paints a picture of a well-balanced, uniformly strong structure.
Uniformly strong? I think that's a bit of a stretch. If we're talking about load-bearing walls, this looks like one wall's made of reinforced steel while another one is made of plywood. Just look at this comparison. On the left, we have the strongest pillar, services. It's an absolute monster, generating a return on tangible common equity, or RoTCE, of 27%. That is truly world-class efficiency. But then on the right, you have the weakest pillar, wealth. Its RoTCE is just 10.8%. That's a massive performance gap. We're talking more than double. And it's not surprising, really. Services thrives on global trade and corporate cash management, which have been robust. Wealth, on the other hand, is much more sensitive to shaky investor sentiment, and it's still working through some legacy issues. To say all segments are performing well is pretty misleading when one is performing 2.5 times better than another. This isn't a balanced structure, it's a lopsided one. Okay, but let's be really clear on what RoTCE is. It is the single most important metric for judging a bank's core profitability. Think of it like this. For every single dollar of their own physical hard capital they put to work, how much profit do they generate? It just cuts through all the accounting noise. Now, while the skeptic is right that there's a variance between segments, the most crucial number here is the firm-wide total. And Citigroup delivered a firm-wide RoTCE of 13.1%. What's important here is the context. Their own target for the entire year was between 10 to 11%. They didn't just meet their goal, they blew past it. So yes, some walls are stronger than others, but the overall structure is performing well above its own design specifications, and that is a sign of fundamental strength. Okay, admiring the strong walls, that's easy. A real inspection, a true stress test, means you grab a flashlight and you go looking for the cracks. You have to actively search for the vulnerabilities, the hidden risks, and the potential points of failure that could bring the whole thing crashing down under pressure. And believe me, there are always cracks. Let's start with the most obvious one, the cost of this whole operation. Right here, while everyone is cheering the 14% revenue growth, they seem to be conveniently ignoring the 7% jump in operating expenses, which now stand at $14.3 billion. So for every $2 of new revenue they brought in, $1 went right back out the door on higher costs. That is a huge drag on margins. Costs are not going down, they're going up significantly. A 7% increase is not trivial. You can't just brush that under the rug. This is a crack in the efficiency story. We need to know what's driving this and if it's even under control. And when you dig in, it gets more concerning. The expense jump is partly from higher severance costs as they continue this transformation. You know what that means? They're paying people to leave. They're also taking hits from foreign exchange. But the real warning signs are further down this list. They've set aside $2.8 billion for credit losses. That's not a hypothetical number. That is money they expect to lose.
They've also added another $597 million to their allowance for future loan losses, citing increased uncertainty in the macroeconomic outlook. And here's the real kicker. The same geopolitical tensions that fueled their trading revenue are a major risk to their deal-making pipeline. So the very thing that helped them could poison the well for future quarters. The bank itself is telling you it's preparing for things to get worse. I see this differently. You see these as cracks. I see them as the planned, budgeted, and necessary cost of a massive renovation. You can't forge your financial fortress without tearing down the old, weak structures first. The higher severance costs? That's the price of simplifying the organization to make it stronger and more efficient for the long haul. The provisions for credit losses? That's not a sign of weakness. That is a sign of prudence. It's a disciplined builder reinforcing the foundation before the storm hits. This isn't panic. It's preparation. They are actively spending money now to reinforce the structure, making it more resilient for the decade to come. This is simply the cost of building something that lasts. All right, we've reviewed the blueprint, we have tested the foundation, we've inspected the load-bearing walls, and we've searched for cracks. We've heard the bull case for a structure that's being rebuilt stronger than ever, and we've heard the bear case for a facade that's just being propped up by temporary market forces. It's time. It's time to weigh all the evidence from our inspection and issue the final verdict for investors. So let's summarize. On the strength side, the pillars are undeniable. You've got record revenue and net income, a powerful statement of intent. The 13.1% RoTCE is well above their target, showing some impressive efficiency. There's documented growth across all 5 business segments, and they are returning massive amounts of capital to shareholders. These are pillars of solid steel, but the cracks are just as real. A 7% rise in operating expenses is a serious drag. There is a clear over-reliance on the adrenaline shot of volatile trading revenue, especially that 39% jump in equities. The segment performance is demonstrably uneven, with wealth lagging significantly behind. And the bank is actively increasing its provisions for future credit losses, which tells us they see trouble on the horizon. These aren't just cosmetic issues, they go straight to the foundation. So here it is, the official verdict from Iron Financial. Citigroup's Q1 performance is like a massive, impressive renovation. The new additions are strong, the finishings are top-notch, and the overall structure is more profitable and more efficient than it has been in years. The ongoing transformation under Jane Fraser is clearly bearing fruit, and the reinforcement work is significant. However, a core part of that foundation rests on the unstable ground of market volatility. The reliance on trading revenues, combined with the rising costs and provisions for future losses, means this structure has not yet been fully stress-tested by a true market downturn. The renovation is impressive, but investors must watch for foundational cracks if the ground starts to shake.
And that leaves us with the ultimate question that you, the investor, need to answer. Are you looking at a masterpiece of financial engineering, the beginning of a durable, long-term turnaround that will make Citigroup a true fortress for years to come? Or was this quarter just a perfect storm, a temporary boost from market chaos that masks the same old cracks in the foundation? That's the multi-billion-dollar question, and the answer will determine whether this structure stands tall or comes crumbling down. Stay sharp out there. We'll help you cut through the noise.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.